Assalamu alaikum to everyone. Dear students, as I think everybody knows that the pattern of consolidation, it has been changed, how it will be tested. Only the format, there's a change in the format, which is a really good change, I would say. Other than that, everything in the consolidation, all the concepts, each and everything is same except I would say one thing, that is the presentation. Now you'll be getting a draft consolidated. It could be SOCI, it could be SOFP, it could be cash flow statement. You need to just show the proper adjustments into that drafted consolidated accounts. Let's deal with this question. That is your specimen of September 2023 according to the new format. Chuckle company, on your left hand you can see the exhibits. Exhibit 1 relates to initial acquisition of green company. Then exhibit 2 belongs to subsequent acquisition of green company, and the third belongs to fair value of net asset of green company, and the last one is the drafted consolidated SOFP. 30 marks question. We have word processor and a spreadsheet to answer. Okay, let's see. Chuckle company has equity interest in several companies. Parent, which has equity interest in several companies, including the Green company. So Green is one of the investment. The director of Chuckle company have prepared an incorrect spreadsheet of the consolidated statement of financial position at 1st April 2006, included in pre-formatted response option and exhibit. All goodwill other than that relating to green company has been impaired. Okay, all goodwill other than the relating to green company has been impaired. The financial year end is 31st March. The following exhibit available: initial acquisition of green company, initial purchase is 30% of the green company on 1st April X4. So let us deal one by one. Let's go to initial acquisition of green company. Let's see. On 1st April X4, the way back, Chuckle company acquired 30% equity shares of green company. Now listen. Before doing this, let's first see the requirements. These are the requirements. A1, using exhibit 1 only, discuss why green company should classified as an associate and not a subsidiary. So what you have to do, it is, I think it is recommendable, you can do one thing. Just copy paste the requirement. So Control C. I want to go to spreadsheet. Control V. Oh, what? This is, I opened something else. Oh, I wanted to go to word processor, not the spreadsheet. My bad. So using exhibit 1 only, discuss why green company should be classified as an associate. So these requirements, they will automatically become your headings as well. Now let's read. On 1st April X4, Chuckle company acquired 30% equity interest of green company. The consideration consists of 100 million cash. Okay. The carrying amount of the net asset of the green company on 1st April X4 was 286 million, which was the same at the fair value. It means no fair value adjustment. Since then, green company has been stated at cost in the consolidated financial statement of Chuckle company. Now listen and listen carefully. Normally, if parent is having holding around 20 range, the range of the holding is from 20 till 50%, then normally we treat that company as an associate. Associate is an organization where you have significant influence but not the control. And where, let's say, once we decide that green company is an associate, then obviously you cannot state, you cannot keep that associate at cost in group accounts. You have to follow the equity method accounting in group accounts. Equity method means the original cost of investment, add share and post acquisition net assets of associate. So let's see, parent is having 30% holding. The remaining 70% of the equity share of Green Company at 1st April X4 was owned by a few other investors. So they are not diversified, they are not dispersed, they are saying few, none of which own more than 10% of equity of the Green Company. Analysis shows that all the shareholders have voted independently, okay, in the past. There has been no clear past voting pattern suggesting that Chuckle Company is unable to directly influence the economic decisions of other investors. Chuckle Company and the Green Company share some key management personnel. They do share some key management personnel. The carrying amount of the net asset of the Green Company 31st March X6 was 348. Initially it was 286, okay. The increase in the net asset of Green Company since acquisition was solely due to profits. Now listen and listen carefully. And Green Company has not paid dividends. So what sort of discussion is actually required? Why Green Company is an associate? Very simple. Basically, Chuckle Company is having one, it is having 30% holding. Second, Chuckle Company does not have the majority of the holding in Green Company. Chuckle Company does not have the majority of the holding is with other investors, and they are just few. And previously they voted independently, and there's no voting pattern also. So all these things, they show that Chuckle Company is not, right now it is not in a position to control the Green Company. So that is why Green Company is treated as an associate. So for part why it is treated as an associate, I just explain you, and just to save the time, I have done the drafting part already. You can just see Green Company should be treated as an associate if Chuckle have significant influence, or a subsidiary if Chuckle Company have control. In order to have control, Chuckle Company needs to have power over Green Company, exposure or rights to variable returns, ability to use that power to affect returns. This is all what we have discussed in IFRS 10. An investor would usually have control if they have the majority of the voting rights. Significant influence is the power to participate in the financial and operating decisions, policy decisions of the investee. Chuckle has 30% shareholding as they own less than 50%. Chuckle should consider if there are other factors which indicate that they have a power and they therefore control. The other investors do not appear to be dispersed, and they have all voted independently in the past. So there is no evidence of an agreement to vote with other investors. The two companies share some key management personnel which can be evidence of the control, but there is insufficient evidence here. Therefore, no further factors that imply Chuckle Company have control. Instead, they have significant influence, and therefore to treat Green Company as an associate. So that is all your exhibit 1. Now let's go for exhibit 2. Before this, let's see the requirement of exhibit 2. Wait. Using okay, exhibit 1 only explain how Green Company should be accounted for an associate using equity method in the consolidated. So where is 3 marks? Let me tell you. Under equity method, what do? We take the cost of investment and simply we add share and post, share in the net, share in post acquisition increase in the net asset of associate. So all you need is just explain the equity method in point number 2, and that I've already done. Look at this. Explain how Green Company should be accounted for as an associate by using this. The investment in Green Company is stated at cost in group accounts, which is incorrect. You cannot keep investment and associate at cost in group accounts. A single line should be recognized in the consolidated SOFP under non-current asset title investment and associate. This is based on cost of investment and plus parent share of post-acquisition net assets of associate. At March X6, the investment in associate has to be 118.6. The increase of 18.6 since acquisition would also be recorded in group retained earnings. This means prior period accounts contain an error which should be adjusted retrospectively as per IAS 8. How did I calculate 118? If I tell you quickly, the cost of investment is 100 million, then simply add share and post reserves 348 minus 286 and into 20%. I'll get 18.6, that is 118.6. So by 18.6, investment in associate will increase as well as the group retained earning. Let us show this calculation. Oh, no. Come over here. Let us show this calculation little bit on this draft consolidated SOFP. That will also help us. Let's see what. Oh, I was just surprised. What was that? They've given us the draft. Okay. So we can only show the adjustments. Okay, we can only do the adjustments here. For working, let us go to the spreadsheet to show the working. Why am I getting the same thing again? Just a minute. Just a minute, let's see. Spreadsheet is here. Okay, workings. They have given us the pattern of the workings, so let's go for working one. And dear student, listen and listen to me carefully. When you are using the spreadsheet of ACCA, it is very slow as compared to what we use in our at homes. So that is why you have to be, I would say, simply you need to show the patience. And we are doing A2. This is not the okay. Working one, investment in associate. Investment in associate. So simply take cost of investment. They have given us the cost of investment 100 million. Add simply share in post equity. Post acquisition. Increase in net assets of associate. So simply now associate is having net asset 348. Earlier it was 286, bracket close, into 20%. Into 20%. Let me check why I'm having 12.4. Let us see. Actually, the holding is not 20%, it is 30%. It is not. So here comes your investment in associate. Investment in associate. Simply add both of these values. So that is simply a working one of investment in associate. So we just in subsequent acquisition of Grin company. Let me show you the drafting little bit, which I've already done. It's here. The drafting part is here, and I just showed you the calculation also. Now let's see what is the exhibit 3. Exhibit 3, I need to zoom in a little bit. I think now it's better. The directors of Chuckle Company have prepared a spreadsheet of the consolidated statement of financial position. Okay. As at 1st April X6, Exhibit 4. Okay. The investment in the Green Company have been stated at cost 100 million and 66. The net asset of Green Company have been included at the carrying amount. The equity of the Green Company has also been included as a balancing figure. Goodwill has not been calculated. Okay. The consideration for the further 18% of equity shares of Green Company on 1st April X6 is included in SOP at the cash amount of 66. They also, Chakal Company got the additional holding in Green Company, that is 18%. The fair value of the original 30% equity interest was 127 at 1st April X6. It's very important. At 1st April 6, Chakal got additional 18%. Let us go to the requirement because something is missing. C1, what they are saying. Using Exhibit 2, explain briefly why additional purchase 18% in equity in Green Company should be accounted for in the group account. Should be accounted 18% equity in Green Company should be accounted for in consolidated financial statement of Chakal Company. So you need to explain how additional 18% equity in Green Company should be accounted. So what should be the accounting treatment of additional equity, 18% equity in Green Company? We need to explain that. C1, it's just a 2 marks question. Okay. Now let's read. Okay, what they're saying now. Initially they had 30% holding. Now the holding goes to 48%. Included within the non-current asset is some land. Okay, I'm not reading this part. On 1st April X6, the director of Chakal Company also identified the Green Company had internally generated database. Leave that. Current tax rate is 20%. I'll come to this. Chakal Company measures non-controlling interest as a proportionate share of net asset. Now listen. Why it should be included in the group accounts? The number one thing is this 18% additional holding should be treated as step acquisition. Initially they had a holding of 30, now 18, so it becomes 48%. So the remaining shareholders they have 52% holding, but obviously they are not disbursed. And one more thing, still the majority is with the remaining shareholders. They don't have the majority. So just a minute, they don't have the majority. Let's see. Non-controlling interest will be measured at proportionate method. Something is missing. Some information is missing. Yes, here. That is, Chakal Company acquired a further 18% Green Company on 1st April X6. The remaining 52% of the equity of the Green Company at 1st April X6 is owned by a few other investors, none of which owns more than 10%. Okay. On 1st April X6, Chakal Company also acquired some share options. That's very important now. In Green Company, exercisable anytime until 31st March X7. The exercise price of the option at 1st April X6 was just above the market price of the Green Company shares, which means right now the option is out of the money because exercise price is more than the current share price. Green Company has been profitable for a number of years and share price has been on an upward trend. This is which is expected to continue. Chakal Company would increase its ownership to 60%. Should it exercise its right, it is believed that there would be additional cost saving should the additional shares be acquired, as decision at board level could be made more efficiently. Now listen carefully. What is happening actually? Right now, exercise price is more than the current share price, which means that option is out of the money. But since the share price is having an upward trend, so it means we can estimate the share price will increase. Increase in the share price means if we exercise these option right now, we can anticipate the cost saving. So we can say these share options deemed to be substantive. So due to that, the holding of basically parent company becomes 60%. So basically after including the share options, the holding goes to 60%, which is the majority. That is why Green Company now at 1st April X6, it is your subsidiary. It is no more your associate. So what will be the drafting for 2 marks? I have already done that to save the time. Okay. The classification of Green Company should change to subsidiary if Chuckle Company have obtained control at 1st April after additional 18% stake in Green Company. Chuckle Company now have 48% shareholding, so they will do not have majority right now. The remaining shares are owned by a few other shareholders, none of which own more than 10%. So these are unlikely to be considered disbursed. Chuckle Company have acquired some share options, so they need to assess if they have control through potential votings. Rights. The share options are currently exercisable even though the right now exercise price is above the current share price. Share price is expected to rise, which means cost saving is anticipated. Therefore, these rights deemed substantive. The share option would take shareholding 60%, that is the majority. It seems at 1st April X6, Chuckle Company have control over Green Company. So should be a subsidiary. Now what will be the accounting? The accounting is very simple. Let me show you the requirement. What will be the accounting now? Requirements. C2. Using Exhibit 3. Explain how fair value of non-current and current asset of Green Company is possible in X6, including any deferred tax adjustment should be calculated. Number 1. Since at 1st April X6, now you have a control. Green Company is no more your associate. It has become your subsidiary. Number 1. By using equity method, whatever the carrying amount you have, that will be compared with the fair value. There will be fair value remeasurement, and the change due to fair value remeasurement will go to group profit and loss. Another thing, if there are any fair value adjustments, and due to those fair value adjustment, if the deferred tax liabilities is going to arise, then deferred tax liability will reduce your net asset at acquisition, and due to that your net reduction in the net asset will increase actually your goodwill. So now let's read the data so that you should get a really good point. Okay, it's here included in the, so number 1, what do you have to do? Basically the consideration of the further 18% equity included in SOSFP is the 18% holding, they got it for 66. The fair value of the original 30% equity interest is now at 127. It is now at 127. So let me show you this calculation. Let's go to spreadsheet. Simply before the control, at the time of actually control, we need to remeasure the fair value of associate. So the carrying amount is 118.6, but at 1st April X6, the fair value is 127. Fair value at 1st April. The fair value is 127. So simply gain to group profit and loss. The gain will be 127 minus this. The gain is actually 8.4. The gain is 8.4. Okay, now go back to the question again. Okay, so logically the cost of investment will be 66 plus 127 while computing the goodwill. The carrying amount of the net asset of the Green Company were as follows. Non-current asset, current asset, okay. Included within the non-current asset is some land. The carrying amount of this land at 1st April X6 was 50, but the fair value is 60. So the land, there is a fair value upward fair value adjustment in the land by 10 million. But due to that, if the deferred tax liabilities comes, if the deferred tax liability which relates to fair value adjustment, it actually reduces your net asset at acquisition and increases the goodwill. So there's a fair value adjustment in the land by 10 million. Current asset included finished goods, cost 84, the fair value of these goods is 131. So let me use a calculator. 131 minus 84. There's a fair value adjustment of 47. On 1st April X6, the director of Chuckle Company also identified that Green Company had an internally generated database of customers who were likely to be interested in purchasing their products, although there were no contractual or legal rights associated with this database. A professional expert has estimated that competitors of the Green Company would be prepared to pay 5 million for this database. So this 5 million is your fair value adjustment. This will also create deferred tax liability. Green Company has not recognized the database as an asset within the individual financial statement. The current uh, rate of tax is 20%. This rate should be applied to any fair value adjustment deemed necessary. Okay, Chuckle Company measures non-controlling interest as in proportionate share of net. It means we need to follow actually partial goodwill method. Now let me first show you a little bit discussion and then we'll go to the calculation. Assets should be measured at fair value at the date of control is obtained, that is 1st April X6 by using IFRS 13. Land should be measured at fair value 60 million in consolidated account. This should reflect the amount of the land could be sold in an orderly transaction. In group accounts, the carrying amount is 60. Uh, tax based on figure is in single entity accounts 50 million. Therefore, 10 million is a taxable temporary difference. So there's a 2 million deferred tax liability. Finished goods. Finished goods should be measured at 131, at which reflects their estimated selling price less cost and reasonable profit margin. So there's a fair value adjustment of 47, which results in a deferred tax liability of 9.4. Database fair value adjustment is 5, which results in a deferred tax liability of 1 million. This is the just discussion which is needed. Now let's go back to the question. Now let's perform the calculation in your spreadsheet. Actually, now what do you have to do? Let me show you your adjustments. Draft consolidated statement of financial position for the Chuckle Company. Actually, we need to adjust now all the adjustments in this draft group accounts. That is extremely, I would say, important part. The number one adjustment, the number one working, I would say, which we did, that was equity method. And by using that equity method, we increase the, I would say, carrying amount of the investment by 18.6 and the retained earning is increases by 18.6. It means if I say that, okay, let's use this. It could be, you can say that either working one, or let me use the equity method. So due to equity method, what happened? Investment in associate will be increased by 18.6. If I try to use the link, if possible, it is here. No. This was this. I think it's not, the link will not work. No. So you have to just write. So it will be increased by 18.6 million. Not only investment and associate, basically your group retained earning will also increase. Your group retained earning will also increase by 18.6 million. This is our first adjustment. Okay. Just a minute. Okay, done. Okay, this is equity method. Now let us try to see what are the other adjustments. The first we went for equity. Now listen. Another adjustment. Basically, we need to calculate the goodwill. While calculating the goodwill, we have to take obviously uh, fair value of 18% additional investment, which is 66, and the fair value of the remaining investment, which is 127. Okay. Then let us first calculate the goodwill. Then I'll show you what else do we need to do. So far we have done only one working. Now let's go for working two. Goodwill at acquisition. Let's workings are here. Let's calculate goodwill at acquisition. Let's say cost of additional 18% holding. They've given us 66. Oh. Fair value of the existing 30% holding. So fair value of original 30%. 30% holding. They have given us 127. We need to have fair value of NCI. Simply less fair value fair value of net assets at acquisition. So fair value net asset acquisition they have given us. Let's see. You can see the total is 348. The total is 348. Actually, that is 348. Less fair value of net assets, less what to do. Okay, I'll show you. Minus 348. Okay, you can do one thing. Just write 348. I'll show you what to do. Now there's a fair value adjustment in land. 10 million inventory was 47. So just add fair value adjustment. Land. It is 10. Fair value adjustment was in inventory. Finished goods 47. That was 131 minus 84 if I'm not wrong. And database fair fair value adjustment database, that's 5. Now listen, all these fair value adjustment they will result in deferred tax liability, and that will reduce the net fair value of the net. That will actually reduce the fair value adjustments. That will actually reduce the net asset at acquisition. So simply deferred tax. So simply deferred tax liability relating to fair value adjustments. It has to be here. Minus, now please see, 10 plus 47 plus 5 bracket close into 20%. The tax rate is 20%. Okay. Now actually we need fair value of NCI also. So let me show you how to calculate the fair value of NCI. Let's try. 348 plus 10 plus 47 plus 5 plus negative fair value adjustment into, now we have 60% holding. It means the 60% holding will be after actually exercising the share options. But right now we have 48% holding. It means NCA is having 52% holding. But why we are saying we are doing consolidation? Because Chuckle will exercise that share option. On that basis we are doing this. So NCA holding is 52%. So NCA I'm getting that is 206.75 something. So here comes your goodwill at acquisition. Now you have to be careful how to calculate goodwill at acquisition, because we need to add 66 plus 127 plus 206.752, and then we need to deduct all the net assets at acquisition. Let's see how to tackle with that. Take this. Now listen, we need to actually deduct all the net assets at acquisition. No, something went wrong. No need to use a sum formula. Take this plus this plus this. It is up to you. You can change the format if you want. All I need is you need to calculate the goodwill. The goodwill which is coming, it is 2.152 something. Okay. So the goodwill is actually, goodwill at acquisition is 2.15. Now listen and listen carefully. In group accounts, basically, in group accounts, now what happens? You need to remove the investment in your subsidiary, as well as you need to remove the equity of your subsidiary. If you check, they have shown you something. See, Grin's equity will be removed. We need to remove the Grin's equity. And what else we need to show? Let me show here. Actually, I would say that is second adjustment, gain on remeasurement. Gain on remeasurement. What was the gain? Actually, the gain on remeasurement was 8.4. And due to that 8.4, obviously your investment in associate will increase. Your investment in green company actually increases, as well as basically with 8.4 your investment value will increase, but we are not going to show that increase of investment, because in group accounts actually what do? We actually do not show investment in our subsidiary. So we can do directly one thing. Just with 8.4 we'll increase the retained earning. That is 8.4. Okay, now what? You have to show. Now if I quickly show the fair value adjustments. So we have a fair value adjustment in land, inventory and database. So I'll use the third column. Fair value adjustment in land. That will increase the property. That will increase the property, plant and equipment by 10 million. And what else? We have a fair value adjustment in fair value adjustment database. Okay, the database was 5. Fair value adjustment, simply database. So where to show that database? We can show that database in other non-current assets. You can show this in other non-current assets, which is 5. There's one more fair value adjustment, that is inventory. Inventory. So that is 47 million. It will increase your current assets. We have non-current assets. We have current assets 554. So it has to be here 47. Now what else? Actually we need to remove Grins equity 348. In group accounts we need to remove Grins equity 348. Let us remove this. I'll be using this column. Remove Grins equity. Which is 348. Grins equity, Grins equity, Grins. The column which we have selected is H minus 348. Okay, what else we need to remove? Actually, we have to now eliminate investment in associate 118.6 because now it is your subsidy. Further 66 also we need to eliminate. So adjustment I, remove investment in associate associate and additional investment. So let's see, it is we were in column I. Investment in associate, I need to eliminate 118.6 and minus 66. This is what we need to eliminate. Okay, now what else we need to show? Goodwill. Can we write goodwill here? Yeah, you can write if you want. But it's better to show the adjustment. This is I, let's go for J. Working, no, it was not, it was working to goodwill. So the column, the goodwill, it's here. It is 2.15. So we have calculated goodwill as well. Now what? Let's show non-controlling interest. Adjustment. No. Non-controlling interest. NCI. NCI can be seen in working too also. It was 20, I think 6.8. NCI was NCI. 206.8 is the NCI. Now we need to check, adjust the deferred tax liabilities because of non-current liabilities will change due to deferred tax liability, because deferred tax liability will arise due to each fair value adjustment. So we need non-current liabilities, deferred tax liability will change. Deferred tax liability will change due to fair value adjustments. Let me show you. Where are the fair value adjustments? That is land. Okay, that is EFG. EFG. Let me show you deferred tax liability. Multiply this with okay, it's not working. Control Z. Something went wrong. It was 10. Let it be 10. Okay. So 10 multiplied by 20%. Second fair value adjustment was, I believe, database. Third was inventory. That is 47 into 20%. If I'm not wrong. Yeah, that's correct. Now let's go for the total final. One more column. The column of, you can say, total. So let's see what will be the total. So this plus, we can do one more thing. If I use the option drag, let's see if it works. So just a minute. No. Well, logically it should be, drag option should be working. I don't know why it is not working. Something is wrong. Okay. Oh, no. Let's try to use a sum formula. Can we use a sum formula? Why I'm unable to use the sum formula? Now it will work, I believe. So we are having 203.1. Let's see. Do we have the option of drag? I think yes. So that's the job is done, I believe. Let's see the column of the total. We have 203.1. The goodwill is 2.15. Then we have 191. Then I got, sorry. One mistake. Actually, this should not come here. Let's use the sum formula. So actually the non-current asset, they are coming 222.4, current asset 589. Okay. Then actually we need to change this total assets. Let me use the sum formula. Current assets and then non-current assets, that's it. So the total is 218.15. Then the equity total is coming, again I have to change this total. Sum formula, So I think I made some error. The equity is 1184. It is coming 1704. Okay. Then non-controlling interest. We had non-controlling interest, if I'm not wrong. It was 206.8. 206.8. That was the non-controlling interest. Just a minute. Non-controlling interest should come here. 206.8. Grains equity has to be 0. Now deferred tax liabilities. The total of deferred tax liability is 326.4. We need to remove this. So actually you have to be a bit careful for this total liability, and I have to show you the total of liabilities as well as equity. So it goes till here. That's it. So I'm getting 2237.5. Oh, we have non-current liability as well. We have non-current. Mistake again. Just a minute. What about this this current liability? Total liabilities. They are asking. Let us show you the total liabilities. Take the current plus the non-current liabilities. Okay, now just show the total non-current liabilities plus equity. Take this total liabilities, NCA and equity. I'm getting 218.3, 13.2, and see, Alhamdulillah, it is balanced. But dear students, seriously, I would request every one of you. I took 1 hour, even though I did the drafting earlier. But to be very honest, dear student, you people have to spend some time. Otherwise, it is easy, but bit time consuming. It is time consuming. So thank you very much. This is all about, I would say, test 11 as well as the new pattern of the consolidation. So thank you very much for watching this lecture. Have a nice life. Assalamu alaikum.